Well, many people may be sitting around the kitchen table this morning trying to figure out bills and retirement investments. After Thursday's dramatic stock market plunge of 512 points, a lot of people are asking if they should reassess their investments. Thursday's plunge was the worst one-day point drop since December 2008. And as you can imagine, investment firms have been fielding questions by the thousands. We stopped by Morgan Stanley Smith Barney to hear what they're telling their clients. Take a listen.
A little bit better news on jobs, a little bit better than people thought. Not great, 9.1. Yep, oil's up 40 cents, and total down 5% yesterday. Your portfolio was down 3.1, your equities, so it did relatively well. Bonds are going to be okay, I think, for the most part. The debt deal is very disappointing to many. It really wasn't a deal. It just kicked the can down the road, as they say. So no real cuts in the immediate time, but it looks like down the road they will.
Well, that was broker Ron Hart talking to his clients, and he joins me live this morning. And Ron, at your firm, what are the biggest questions that are coming up?
What's the next shoe to drop? Is this it? Is it already in the news? Should I take money out of the market now? Traditionally, that's not a good idea. Most investors panic at the wrong time. The stock market, the S&P 500, gets you 9.1% over time. The average retail investor, the average person, gets 3.8%. The reason they do that is they panic. They get out, and the market's a very fickle thing, and mostly it discounts future activity. For example, the 500-point day Thursday was in anticipation of the S&P downgrade, probably. So once it's in the market, usually when the bad news is out, it tends to get its footing and go higher.
All right. What does it mean in today's climate to be rich compared to middle class? Because we hear a millionaire tax on people making, a $250,000, not $1 million. So
Exactly.
What does it mean to be rich compared to middle class?
They're saying $250,000 a year in income is rich, and that's the surprise of many people making $250,000. They have private tuition bills, they have expenses, etc. So you're rich based off of what you spend and what your needs are. There's David Thoreau said one time, the richest persons are the people who have the simplest pleasures. And if you have simple needs and simple wants, you're pretty happy. And here's a guy, of course, who lived by Walden Pond in a cabin, so he was pretty simple.
Exactly.
And happy.
And happy for that matter. Many people don't think that they're going to be able to retire at the same standard of living,
Sure.
that they are going to have to change their lifestyle.
Sure. And there's a way to look at that. You sit down with a financial advisor. There are models that you have based off Social Security you have coming in, pension money you have coming in, how much 401k you have, and you back into the lifestyle that you're comfortable with, you think you can live with. In retirement, a lot of people will sell one car and have, instead of having two cars, they'll have one. They'll move to a smaller town where it costs less to live. So there's a lot of ways to live a reasonably robust life on less money, but you got to address it early. And you address it by sitting down with your financial advisor, human resources people at your company, in your 401k, and be very disciplined about your investing. You cannot stop 1 year and then hope you'll start back. You've got to stick with it, because over time, you'll do well.
Sure, it's got to be disciplined about investing, also disciplined about your lifestyle, too.
Sure, yeah.
It's so interesting. This is why everybody goes to Florida, right? There's no tax down there. But I do want to take a look at age groups, okay? We've got two scenarios. The first is of somebody who is 49 years old. Give us some tips on how they plan, what they do for their retirement.
The younger you are, the more time you have. You can make mistakes. You want to have more equities, stocks, because over time stocks do better than bonds, and you have time to make it up at that age. In this example, they're doing pretty well. They have $500,000 net worth, which is the average net worth of someone who retires in America. Sounds pretty high, but my dad worked for the railroad. He had about that. He had very middle class, but he was a very diligent saver.
Right.
And they had that, and they're living a very comfortable retirement that way. So look at your Social Security benefits. You go online to get that, or your human resources people at your firm will tell you what it is. You get your 401k, and then have enough money to live the lifestyle you want, and sit down with an advisor, and they'll tell you how to do it. It's like an algebraic equation. You got to solve for what you want, and then put the amount in necessary to get where you want to be.
Okay, and let's examine somebody who is making closer to the average American salary, somebody who's 55 years old. Provide some pointers there.
Yeah, the average person really, the average savings rate in America right now is 5.4%. That's what the average person is able to save. They save less in a recession because there's more demand for money at home and kids, etc. But you need to be disciplined about that. that person needs to really explore what their firm will do for them. Some firms match 80% of what you put in your 401k. Don't let that go to waste. I mean, that's just a freebie, and a lot of people don't do it. The other thing is there's a tendency to want to withdraw from your IRA when you need money. Very expensive money. Please fight the temptation to do that, because it's the most expensive money you can borrow.
Okay. All right. Ron Hart, thank you so much.
Thanks.
Really appreciate it. Next time you come back, I'm going to ask you a question as to how you plan with what you've got, because I think that's kind of an interesting thing. Ron Hart, thank you so much.
Thanks.
Appreciate it.